Hey everybody, it's your boy Jupiter, and welcome back to the channel where we talk all about financial wellness. If you're new here, please like, share, and subscribe. It really goes a long way to help out the channel, and we really appreciate all your support. And don't forget to check out the description for offers that can help you with your financial future. So today we're going to talk about retirement accounts. Now, retirement accounts are really important. Nobody's trying to work forever. So it's always good to get started on thinking about your financial future when you get retirement age, when you get older. There are three types of retirement accounts that are normally provided. So we have the 401k plan, which you usually get from your job. We also have IRAs, and there's two different IRAs. We have a traditional IRA, and then we also have a Roth IRA. And there's some distinctions between the two. So let's get started. Okay, so first one we're going to talk about is your 401k plan. So your 401k plan is a defined contribution tax advantage retirement savings plan that is sponsored by one's employer. In a nutshell, it's a retirement plan set up by your job. And there are different things that you can do with it. So let's talk about it some more. So a 401k plan is a retirement savings plan offered by many American employers that has tax advantages for the saver. The employee who picks up a 401k agrees to have a percentage of each paycheck paid directly into an investment account. The employer may match part or all of that contribution. The employee gets to choose among a number of investment accounts, usually mutual funds. So we have some key takeaways here for the 401k plan through your job. So there are two basic types. We have a traditional and a Roth IRA, which differ primarily of how they're taxed. It says with a traditional 401k, employee contributions are pre-taxed, meaning they reduce taxable income, but withdrawals are taxed. So this basically means it won't get taxed when you put it in, but when you want to take it out for retirement, it is going to be taxed. And then we also have the Roth 401k, which are made after tax, with after tax income. There's no deduction in the contribution year, but withdrawals are tax free. So for a traditional 401k plan, you can take a deduction of how much you put into that plan every year on your taxes. For a traditional, but for a Roth, there's no tax deduction. But the benefit of this is that your withdrawals are tax free. So you get taxed when you put it into a Roth 401k, but when it's time for you retirement, then they don't take the taxes out, which I think is great. It says employee contributions can be made to both traditional and Roth 401k plans. So let's talk about how they work. It says with a traditional 401k plan, employee contributions are deducted from the gross income. This means money from your paycheck before income taxes have been deducted. As a result, your taxable income is reduced by the total amount of contributions for the year and can be reported as a tax deduction for that year. No taxes are due on either the money contributed or the investment earnings until you withdraw the money, usually in retirement. So that's for your traditional 401k. Now for your Roth, contributions are deducted from your after-tax income. This means that contributions come from your pay with after-tax income that have been deducted. As a result, there's no tax deduction in the year of contribution. When you withdraw the money during retirement, though, you don't have to pay any additional taxes on your contribution or on the investment earnings. which is great. So we have some other things here. Even though contributions to a Roth 401k are made with after-tax money, generally, if withdrawals are made prior to the age of 59 and a half, it could trigger tax consequences. Always check with your accountant and qualified financial advisor, which I am not. Disclaimer, prior to withdrawing money from either a Roth or a traditional 401k. It says, however, not all employees offer the Roth account. If the Roth is offered, you can choose between a traditional and a Roth 401k, or you can contribute to both up to the annual contribution limit. So that's another important thing. So let's talk about the annual contribution limit. Let's see if we can find those numbers here, because I know they're here. Here we go. Contribution limits. Says the maximum amount an employee or employer can contribute to a 401k plan is adjusted periodically for inflation. So every year they usually add like $500 or $1,000 to how much you can put in because of inflation. And we'll talk about inflation in another video. It says for 2024, the annual limit on employee contributions to a 401k is $23,000 per year for workers under the age of 50. However, those age 50 and over could make a $7,500 catch-up contribution on top of the $23,000, which is great. And for this year, which is 2023, is, as you can see, it's $22,500. So they added another $500 for next year. And you still, if you're over 50, you still have the $7,500 catch-up contribution from your job that you can put in there. So yeah, that's the main thing with your 401k plan from your job. If you have a job, a good job that offers it, please take advantage of it. A lot of the times they will match you, and that's basically free money that you can invest for your future retirement. Okay, so let's talk about the other ones, which are the IRAs, which are individual retirement accounts. So let's talk about a traditional IRA. It allows individuals to direct their pre-tax income towards investments that can grow tax deferred. Tax deferred basically means you're going to pay those taxes at a later date, usually during retirement, just like we saw with the traditional 401k plan. The IRS assesses no capital gains or dividend income taxes until the beneficiary makes a withdrawal. And income thresholds may apply, and you're going to see the income thresholds are a lot different for these individual retirement accounts. And it says contributions to a traditional IRA may be tax deductible depending on the taxpayer's income, tax filing status, and other factors. Retirement savers may open a traditional IRA through their broker, including online brokers and robo-advisors or a financial advisor, or through your bank now, because I know that Chase and Citibank have it. Probably some other banks offer these products, which make it really easy to get started investing for your future retirement. So let's talk about some takeaways. Let's see, what didn't we go over? Withdrawals are taxed during your retirement, of course, at the IRA's owner's current income tax rate upon retirement. So that's one of the drawbacks of the traditional IRA. Like, yes, you can take the tax deduction when you're working, and every year, whatever you put in there, you could take a little tax write-off. But you're going to take a hit when you do take it out during retirement, because you will have to pay income taxes on it. It says account holders should adhere to the contribution limits and be aware of the schedules required for required minimum distributions. We're going to talk about that a little later when we talk about the Roth and the differences between the traditional and the Roth IRA. It says non-qualified withdrawals from a traditional IRA are subject to income tax, in addition to a 10% penalty before the age of 59 and a half. So they're not playing. They want you to save this money for retirement, and if you take it out before 59 and a half, you're going to get hit with the 10% penalty. So use this money for retirement. Don't touch it until 59 and a half. when if you want to take a withdrawal. If not, you will have some penalties. They do have some exceptions. You will have to pay the money back, but to keep it simple, just keep the money in there and build your wealth for retirement. That's the main advice. It says, unlike IRA contributions, traditional IRA contributions are deductible from your current taxable income. So let's see what those contribution limits are. Here we go. We got distributions. Yeah, you're going to have to take out that money around 70 and a half or 72 or 73. So that's one thing to definitely think about. I'm looking for, I just saw it. Here we go. Nope, that's not it either. Here, is this it? Yep, here we go. So the IRS restricts contributions to a traditional IRA each year, depending on the account holder's age. The contribution limit for the 2023 tax year is $6,500 for savers under 50 years of age and $7,000 in 2024. For people age 50 and above, higher annual contribution limits apply via a catch-up contribution provision, allowing for an additional $1,000. So that basically means $7,500 in 2023 and $8,000 in 2024. So these limits are much lower than what you would get from an employee plan. So just keep that in mind for your individual retirement account. So that's the basics of your traditional, just basic. So you won't pay taxes when you put it in. You will be able to take a tax deduction, but you will pay income taxes during retirement. So just keep that in mind. So the last one, which I believe is, to me, is the best IRA, is your Roth IRA. So the Roth IRA is a special type of tax-advantaged individual retirement account to which you can contribute after-tax dollars. The primary benefit of a Roth IRA is that your contributions, the money you put in, and your earnings that you get over time with interest on those contributions can grow tax-free and can be withdrawn tax-free after 59 and a half. So just understand that year 59 and a half, anything before then, you maybe can be hit with a penalty. And it's assuming that the account has been open for at least 5 years. So you have 59 and a half, and you also need to have it open for at least 5 years for you to get the tax-free growth and withdraw tax-free. In other words, you pay taxes on money going into your Roth IRA, and then all future withdrawals are tax-free. So that's the main distinction between the traditional. So the traditional is the opposite. You don't pay taxes when you put it in, but then you're going to pay income taxes when you take it out in retirement. So the question to you is, do you think tax rates are going to go down in the future, or you think they're going to go up in the future? I think we all know the answer to that. So that's why the Roth is powerful, because it doesn't matter what the tax rates are in the future. Those withdrawals are always going to be tax-free in the future, which is great. Let's see what else. So the contributions, all the difference is the contributions are not tax deductible. So you cannot write that off as a deduction on your taxes for your Roth IRA, since it's basically funded with after-tax dollars. But once you start withdrawing funds, the money you take out is tax-free. Always remember that for the Roth. Let's see what else we got here. We got some other rules here. It says Roth IRAs are best if you think marginal taxes will be higher in retirement than they are now, and I believe that's what it will be. Single filers can't contribute to a Roth IRA if they earn more than $153,000 in 2023. For married couples filing jointly, the limit is $228,000. In 2024, it's going to be $161,000 and $240,000 respectively. So if you're making too much money, you may not be able to contribute to a Roth IRA. There are ways around it. It's a little bit more complicated, Search backdoor IRA. There are ways to get the money in there if you're making more than $153,000. So it says the deduction amount that you can contribute changes periodically. Again, 2023 is 6,500 plus an additional $1,000 for those 50 and older. And in 2024, the limit increases again to $7,000 with a catch-up contribution remaining at $1,000. So it's the same thing. You can, all the brokerage firms and sometimes some banks can offer a Roth IRA. So definitely check that out. Now, it is 2023 right now, December. So you have up to April 15th to basically contribute to 2023. And then after that, you can't contribute anymore. It's going to have to be for 2024. So even though this year is over, you still have to April 15th to make a contribution for 2023, which would be up to $6,500. And then after that, you can put up to $7,000 in these different IRAs. Now, one thing to be mindful of is that you can have a regular traditional IRA and a Roth IRA. The limits are going to be the same, but they're combined. If you combine both of those, they have to add up. You can't put 6,500 in a Roth and 6,500 in a traditional because you'll be over the limit. So you would have to put in half of 6,500 if you're doing both. So add up to 6,500 at the end of the day. So just keep that in mind. If you decide, hey, I want the advantages of both, you can't go over that limit because they do combine both for that year. So that's definitely very important. So yeah, Roth is very powerful. We kind of know that the tax rates are going to go up every year. So it's definitely powerful in terms of putting the money away. You get taxed on it on that year. And then after that, your investment that you put in can grow. One thing I wanted to touch back on for the 401k plan. So let me go back up here. So 401k plan, again, this is the one you get from your job. So there's some things you need to understand about this that are very important. If you switch jobs, make sure you take your 401k money with you to the new job. Do not leave it with the company's 401k plan. And when I say take it with you, that doesn't mean withdraw the money and then put it into another account. All you need to do is fill out a form to convert it to the new job's 401k plan. If you take it out, withdraw it, you're going to get a penalty. But if you convert it, there's no penalty. Never leave your money in a company 401k plan when you leave and go to another job. Or if you retire, put that money in an IRA or some other vehicle where you control the money. I'm really big on people controlling their money because you don't know what's going to happen with that job in the future. If they go belly up, what's going to happen to your retirement account? And stranger things have happened. There have been instances of people's savings being wiped out. So it's very important that whenever you leave a job, to convert that money to the new company's 401k plan so you don't have any issues in the future. That's my main tip for you, so you don't have to deal with any, agony if your money is stuck at a job and you don't know what's going on with it. Okay, so always convert it and take it with you. Do not withdraw or take it out. Convert it so you don't get any penalties. Definitely wanted to touch on that. Cool. So let's see. Traditional and the Roth IRA, pretty much they're good. I think everyone should have one just so you have control over your money. The main thing is that don't just set these up and put money in them. The money in there needs to be invested. So yes, you can put the $6,500 into a Roth, for example. Don't just put the $6,500 in there and be like, oh, cool, I'm good for retirement. No, you need to invest that in something. Will it be stocks, bonds, whatever you want to do? Index funds, I believe, are really good vehicles for beginners and people who just want to know their money's being invested and you're getting that interest and it's compounding. It's really important that you invest that money. Don't just put it into your retirement account and think, oh, okay, I'm good. Make sure you invest that money as soon as you can. Once that money clears, say you get the $6,500 in there, invest it in a number of index funds as much as you can get, and continue to add on as the years go, as the months go on. When you get paid, put some money, buy some more index funds or buy some more stocks, however you want to do it. It's not investment advice, but you just want to have a strategy where you know your money's working for you, and if the money is just in there sitting there as cash, you're just not being invested and you're not building your wealth. So make sure you always invest your money once you put it into one of these retirement accounts, and you'll be good to go. So I don't have this set up right now. I don't want the video to be too long, but I will show you an index fund, and I'll show you how to read the prospectus real quick. So let's go into that. I'm going to put an SCHG. So let's do SCHG, and SCHG right now is 8168. So SCHG is a index fund that basically index fund is nothing but a collection of stocks of different companies. So what you would do is you would put your money into that account, and then you would buy as many of these SCHGs as you can. This is just for one example. If you wanted to do a different one like SCHB, which is a broad market, or a VOO, which is a Vanguard fund, is up to you. You can do whatever you want, but make sure you invest that money into one of these. So let's go and let's scroll down and let's click on SCHG, just so you can see an example of what it is. All right, let me close that. So it's an ETF, and I have a video on that kind of talks about that, briefly, so you can check that out. Symbol is SCHG. It has the expense ratio of 0.004. So basically, it's $4 for every $10,000 you put in. Is $4 fee, because they're managing it and they're changing out the stocks and things of that sort. That's in the group of stocks. Large cap ETF has a lot of technology in it. It's for growth. You want to accumulate a lot of the money over time. It's really good for that. So first thing we want to click on is the prospectus. So we're going to click on the prospectus. Everyone should read their prospectus to know exactly what's in the fund and if it fits your criteria of what you want to invest in. So let's zoom in on this so we can see this a little bigger. Zoom in, and I'll move this over. Okay, so it's basically telling you it's the Charles Schwab US Large Cap Growth ETF. And again, expenses on $10 investment is $4, which is great. It's really, really inexpensive. You may see some funds that have better returns, but their expense ratios are going to be a lot higher, and you don't want to pay a lot of fees. So let's continue to scroll down. Investment style, equity risk. They have all the stuff here. So let's get to this. Is what we want to see. We want to see the charts for this prospectus. So they have a chart here of the last 10 years from 2012, and this one is from 2021. So it says the total annual returns. So in 2012, it gave 17% return. High yield savings accounts are giving 5% right now, which is decent. Your normal bank is giving you 0.01%, which is basically nothing for a regular savings account. These accounts are giving 17, 33%, 15%. This year wasn't so good. It was 3%. 2016 was 6%. And then 2017 was 28%. When you see these brackets, that means it was in the negatives. 2018 was not a good year for this fund. But what happened the next year? 36%. Next year was 39%. And then the year after that was 28%. Now just think about compounding interest in 28% of 6,500 every year on average. So it says the best quarter was 27.73%. The worst quarter was 15.3%. So it will have its ups and downs. Again, investments carry risk. So do your homework. Make sure that's correct. But it says the year-to-date performance before taxes as of 9/30/2022. So this was 2022. This was 31.62% for that year, which is great. So they give you the annual total returns up to 2021. This is a little old. Before taxes, 28%. After taxes, 27%. 5-year average is 25%. And the 10-year average has been pretty much 20%, which is really, really good. Now, every year is not going to be great, as you saw from this chart right here, but it gives you a sense, just say conservatively, after share distribution and sale of shares, 17%, just say 15% you can get from this every year on average, which is great. But you need to make sure you read the prospectus and also make sure you invest the money once you put it into your account. So let me go back here and let's see if they have any more, because this practice is kind of old. So let's see what they have here for this year. Let's scroll down. Let's go down to performance. So the 1 month, 10%. Last 3 months, wasn't too good, 3%. But the year to date on this, 43%. It's giving back 43% from the year to date, and this is December. So it's really performed really well, and this is where you want to have your money compounding that interest and getting a good return on your investment, which is really great. The next thing I want to show you really quickly is the portfolio. So this basically shows you what's inside of these holdings, these ETFs. So it has Apple, 13%. It has Microsoft, 12%. Amazon, Nvidia Corp, Google, Meta, which is basically Facebook, and you can see the percentages here. Google again, Tesla. So you can see this is very technology and consumer goods heavy. United Health Group and Broadcom. So this is most of what's inside of this fund. So instead of you having to get all of these different stocks individually and track them and be like, okay, I want to sell this because it's not doing good. Every year they call it rebalancing the portfolio. So they take out the ones that are not performing well and they find something that will perform well for the most part. Every year is different. There's no guarantees, but you can kind of see a trend over 10 years is going to, this one gives about 15%. Everyone is different. So do your homework. Just make sure you're investing your money someplace that makes sense, and I think you'll be okay. But I love this fund mainly because it's inexpensive to get started. And it's inexpensive to get started because the price right now, when I got it, it was a little bit less than this. But $82, most people can put $82 every time they get paid. That's why I like the Charles Schwab funds, because they're very inexpensive. The Vanguard ones, they're top notch too. They track the same companies, but they're more expensive. They're almost like $400 for one, $200 or $250 for another one. Good funds, but they're a little bit more expensive and pricey. I like value when I'm investing, so this is a good one because it's pretty inexpensive for the most part. There's another one, and that tracks mainly, really for growth. The other one here that I like is SCHB. It's a broad market. So it's basically the total stock market, everything. And look at the price, $55. Really can't beat that in terms of just getting started with investing and putting your money to work. Now, if you maxed out your IRA, you had it in a Roth IRA, you got 6,500 and you put the max in, how many shares of this could you buy? You could buy a lot of shares, and then you can see that money grow over time. But the main thing is that you want to get started and understand the basics. And once you put the money in, just make sure you invest it in the right place. Again, this is not investment advice. This is just my opinion. and you can take it for wherever it is, but I really just want to give you an example of what you could do with your money. Okay, so yeah, hopefully this has been helpful for you. Go back to the studio. All right, so yeah, please understand retirement accounts, understand how to invest. Once you put the money in, always invest that money that you put in, and you'll be good to go for your financial future. If this video has been helpful to you, please smash that like button, subscribe, share this video whoever needs it. If you have any questions, feel free to leave a comment and I'll be sure to get back to you. Any questions you may have. And this is a community, so please share the knowledge, ask questions. Let's have some Discord in the comments so we can help each other out. And I appreciate all your help and all your support. Thank you very much. And this is your boy Jupiter signing off, and I'll see you the next one. Peace.